Hi guys, this is Ravi and you're listening to me on the Nifty BN channel. First of all, I wish to apologize for being absent for so long, but I'm sure Shreyas has kept you all busy with his intraday trading videos. The channel too has come a long way, and the major credit for this definitely goes to Shreyas, and also to all of you who have been supporting us from day one. I am glad to inform you all that I'll be starting a new series starting today named Weekly Advanced Options Trading Strategy, in which I'll be covering my weekly trades. There would just be one video each week, in which I will summarize the trade and the adjustments I made to it over the course of the week. The video would be tentatively published every Friday or Saturday. But first, the disclaimer. This series is only for advanced option traders, as some level of knowledge of options basics is required to follow the strategy. I use mostly butterflies, debit and credit spreads, but sometimes, especially close to expiry, I also use calendar and diagonal spreads in this strategy. The strategy is a non-directional trade done using the current week options of Nifty. It begins as a very basic low probability out of the money bullish call butterfly and slowly over the course of the week gets translated to an advanced options trading strategy with a high probability of making money. You would not believe, but the probability of profit on the expiry day is usually 95% plus. The trade has two parts to it, the base trade and the weekly income trade. Now, without wasting any more time, let's get started. The base trade, also known as the bullish installment collar, is a bullish trade, as the name suggests, with just two or three legs. The first leg is a future or a synthetic future, and the second leg is an in the money put, which acts as a hedge to the first leg. So all you do is go long on either the future or a synthetic future and purchase an in the money put to provide protection. My base trade looks like this. The first two legs correspond to the December synthetic future, and the third leg is the hedge. Although only 350 quantity of in the money put is needed, I have an extra 50 quantity or one lot which will act as a hedge for any unforeseen or unpredictable event, also known as black swan event. So this extra 50 quantity put can also be called as a black swan hedge. The base trade is optional and you do not have to deploy this if you do not have enough capital in your account or if your broker doesn't allow trading December options. When to deploy and where to deploy the base trade is not the subject matter of this video. But if you wish to know the details, please refer to the link in the description. I have spoken about it in detail and the link directs you to a 2 video playlist. I suggest you thoroughly to go through both the videos and decide whether you really wish to deploy the base trade. Now coming to the weekly income trade. The trade is almost always initiated as an out of the money bullish call butterfly. It is initiated 200 points away from the spot. That is, if the spot is at say 18,200, the bullish call butterfly is initiated at 18,400. That is, you buy one call at 18,400, sell two calls at 18,500 and buy one more call at 18,600. Now you might be wondering why 200 points away. Since the Nifty 50 index most of the times trends up and since the ATM straddle price at the current India VIX levels is about 200, we choose this distance. In case you have the base trade in place as well, you can also sell one call per lot of the base trade. That is, if you have 4 lots of long futures and 4 lots of long in the money put, then you can sell 4 lots of an out of the money call. I usually prefer selling a 10 delta out of the money call. The margin required for this would be less than what it would be required for a naked call sell, as the brokerage would consider this as a covered call. Usually, only 100 multiple strikes are chosen for the out of the money butterfly, as such strikes have good liquidity. So it would be easier for you to exit and enter the butterfly. The strategy is suitable for working professionals also. as you don't have to sit in front of the charts all day. All you have to do is set up alerts, and whenever the alert is triggered, make the suitable adjustment. Now let me quickly walk you through on how to add alerts on the Zerodha platform. If you do not have it already, add the Nifty 50 index to your watch list. Now roll over and click on the three dots and then click on Create Alert. In the window that pops up, enter a name in the name field. Select less than or equal to in the ease field and enter 1850 in the value field, as you want Zerodha to alert you when Nifty goes below 1850. In the same way, create another alert and this time select greater than or equal to in the ease field and enter 18450 in the value field, as you want Zerodha to alert you when Nifty goes above 18450. Now that you have created the alerts, you can find them in the Alerts tab within the Orders section. You can now check and verify if everything is alright. Now the next time the spot value of the Nifty 50 index goes either above or below your specified values, you will receive an alert to your email or mobile phone. Now to the adjustments part. There are two types of adjustments, standard adjustments and advanced adjustments. Now to standard adjustments. Standard adjustments are made only on the first 3 days of the expiry week, that is Friday, Monday and Tuesday. They are done whenever the spot price moves plus or minus 200 points from the point of initiation, that is whenever one of the trigger points is reached. If none of the trigger points is reached, then only advanced adjustments are made in that particular week. But this happens very rarely. Standard adjustment 1. When the spot moves up 200 points from the point of initiation, we roll up the butterfly by 200 points. That is, if the initial trade is a 18200, 300, 400 butterfly, roll up the butterfly to 18400, 500, 600 strikes. Standard adjustment 2. When the spot moves down 200 points from the point of initiation, we roll up the closest leg of the butterfly by 50 points. That is, if the initial trade is a 18200, 300, 400 butterfly, roll up the 18200 leg to 18250. So the butterfly would now be a 18250, 300, 400 butterfly. And it usually becomes a no or minimal downside risk bullish broken wing butterfly. On most weeks, these are the only adjustments you make. Apart from the standard adjustments, I use broken wing butterflies, credit and debit spreads, and towards the fag end of the expiry, even diagonal and calendar spreads to make advanced adjustments. I will discuss these advanced adjustments in detail in the weekly videos starting today. So now I'll walk you through last week's trade. So as per the rules, on 6th January, I initiated the 18,000, 18,100, 18,200 out of the money call butterfly at 3:10 p.m. just before the market closes. The spot price of the Nifty 50 index was at 17,750 when I initiated this trade. I also sold 8 lots of naked 18,300 calls, as I have an underlying base trade of 7 lots of bullish installment collar. So the initial trade looked like this. And the payoff graph looked like this. Most of you must be wondering as to why I took a trade that has unlimited risk to the upside. But the truth is that I have a base trade to cover for that risk. So the naked 400 quantity calls at 18,300 are actually covered calls on the base trade. Since I initiated the trade when the spot was at 17,750, the trigger points to make an adjustment are 17,950 and 17,550. On 7th Jan, Nifty made a high of 17,905. So the trigger point was not reached. On 10th Jan at about 10:17 am, the trigger point of 17,950 was reached, and I had to make the standard adjustment of rolling up the out of the money call butterfly. So I shifted the 18,000, 18,100, 18,200 out of the money called butterfly to 18,200, 18,300 and 18,400 and sold 8 lots of naked 18,500 calls. So the adjustment legs looked like this. So once the adjustment is made, the trade looked like this. And the payoff graph looked like this. On 11th Jan at 1:30 p.m., I initiated 18,000, 17,900, 17,800 out of the money put butterfly to lock some gains in the trade. This is not a standard adjustment and is one of the advanced adjustments that I do to lock some profits in the trade. So the adjustment legs look like this. So now the trade looked like this. And the payoff graph looked like this. I did not make any adjustments on 12 Jan as Nifty gapped up and hovered between 18,170 levels and 18,220 levels. Now to the expiry day. On the expiry day, the first thing I did was to exit the naked 18,500 calls in a profit as I had to free up some capital to make any further adjustments. So I exited the naked 18,500 calls at point 0.8 at 9:20 am. Also, I had to fill up the gap between the two butterflies. So I rolled up the 18,000, 17,900, 17,800 put butterfly to 18,000, 18,100 and 18,200 strikes. And also, I initiated a put calendar spread at 18,200 at 9:45 am. And about 25 minutes later, I also initiated the 18,200 call calendar spread at 10:09 am. So the adjustment legs looked like this. Since I had to do both buy and sell 400 quantity of 13th Jan 18,200 put as part of the put butterfly and put calendar setups, it has been skipped. So now the trade looked like this. And the payoff graph looked like this. I did not have to make any further adjustments and exited the trade at 3:10 pm with a profit of about rupees 19,000. Alright, that takes us to the end of the video. I hope you learned something from this video. And if you wish to track my current week's trade, join the Telegram group BIC Premium. Thank you. And join me again this Saturday with updates to the current week's trade.